Hey Insurance, this is Tony Cañas, Chief Motivational Officer at Insurance Nerds and PNC Client Advisor at the Jacobson Group. And today I want to talk to you about something that's really scary to me. Student loans, Halloween edition, student loans. Student loans are the bane, the cross of my generation, the millennials. Together we hold, as of end of last year, $1.47 trillion of student loans. This is more than credit cards and auto loans. So this is a huge deal. And today's video is both for managers and executives who manage insurance companies and employees at those insurance companies. Basically, we went to school during a time of budget cuts and unlimited student loans where the cost of college just grew exponentially and it became impossible to do the good old-fashioned work for the summer and be able to pay for a semester or maybe a year of college and maybe even housing. Most of my friends worked through college and we all graduated with student loans. Basically, some of them worked full time and we still graduated with student loans. Executives, big thing to understand is for your millennial employees and some of your Gen Zers. Gen Z is being smarter about it because they saw our mistakes. But for most of your millennial employees, student loans are their biggest financial worry. And especially we're talking about people who are in the call center, entry-level claims, or other jobs that are not yet super high paying. Their number one concern, chances are, is their student loan. So anything you can do to help get a little bit of that concern taken care of is a massive retention tool. And we'll talk about that here in a little bit. Millennials, young insurance professionals. If you are not yet at the point where you're making a ton of money, or just you're like me, you make good money, but you so much in student loans that it's not easy to just pay them off. The main thing I want to make you aware of is that there are 4 different income-based ways to pay your student loans, meaning that your monthly payment is based on how much you're making, and you have to recertify that every year. And so the more you make, the more you pay, but they keep your payments affordable. The first one and the oldest is called the income-based repayment plan. And basically that one is based around the idea of paying 20% of your discretionary income. And there's a specific definition of discretionary income. 20% is a lot, right? If you think about it, financial advisors recommend that your mortgage shouldn't be more than a third of your income, but this is your discretionary income. And again, that has specific definition. Then they came up with the income-based repayment plan. And that one, as long as you're a new borrower after July 1st, 2014, it is 10% of your discretionary income. If you already had student loans before January 1st, 2014, so for most millennials, it would be 15% of your discretionary income, so it's significantly better. Then there is the payee plan, which is pay as you earn plan. And basically that one in general is 10% of your discretionary income. And then there is the repayee plan, which is the second version of the pay as you earn plan. This one's called the repay as you earn plan. Anyway, there's a calculator at studentloans.org can help you figure out which one makes sense for you. You can switch every year. Either way, you have to recertify every year, right? So I'm on the repayee plan. Every year in April, I have to recertify by sending in my last couple of paychecks or my tax returns to show how much I made last year and what I'm expecting to make this coming year, so that they can figure out my student loans. So the difference between some of the plans is how long you'll be paying for, basically. So the traditional federal student loan program, you pay for 12 years and you pay the whole thing off, but the payments might be more than you can afford. The income contingent plans go from 25 to 20 years. For most of us, if you work in a nonprofit, you might qualify for 10 years, but for most of us, it's going to be 20 years, 20 or 25, depending on the program. So what happens when you get to the end of those? This is really important to understand. What happens when you get to the end of those 20 years or 25 years, and you've faithfully made your income-based payments or your whatever base payments, and you still have a bunch of money left? Well, that money gets forgiven, and by forgiven, what I mean is the government writes it off, but the IRS considers that with the current law, and I'm not a tax advisor or a lawyer in any way, shape, or form, but in the current law, my understanding is that the IRS considers that income, basically. So you didn't actually receive cash, but you received debt forgiveness, and debt forgiveness in the current law is considered income. So be aware that unless that law changes before you get to the end of your repayment plan, you will have a hefty tax bill coming up, okay? So what it comes down to, basically, the fastest way to pay your student loans off is probably something like the Dave Ramsey plan. Just minimize your expenses and pay off as much as you can each month. But that might not be possible, right? If you have kids or the different situations, it might not be possible. The income-based repayment plans, ultimately, you end up paying a lot of interest. You might end up paying more over the long term, but it keeps it from being too much of a burden during the time that you are paying them. And the law might change, right? Millions of people are on this program, and millions of them won't be ready to pay the taxes, so the law might change. Or focus on growing your insurance career, getting to a point where you can either switch to the standard repayment plan, or the point where you can save the taxes up front for this. For the last couple of minutes of the video, I want to talk to you about the few carriers out there that offer student loan reimbursement. So for many years, since I've been around, most carriers, especially big carriers, offer tuition reimbursement, generally $22.50 a year, but tuition reimbursement is only good for new education that you didn't have when you started with the company. So for years, I've been pushing the idea of a new kind of benefits for a new generation that makes sense for us. And in our case, student loan benefit makes sense. And when my book came out, not a single PNC carrier had student loan reimbursement as a benefit. Today, there is more than one. The first one that came in with student loan reimbursement was Society Insurance out of Wisconsin, just a few months after my book came out. Then Everest Re, then Unum. I think they're not PNC, but they're still an insurance carrier, Unum. And then this year, just huge news. As earlier this year, two ginormous insurance carriers announced their student loan reimbursement plans, Travelers and USAA. So young insurance professionals, take a look at those companies, right? And if you're an insurance executive, take a look at offering student loan reimbursement, because now that several other carriers offer it, and especially two giant carriers like Travelers and USAA, it's becoming table stakes. It is no longer competitive advantage, at least it won't be for long. It's table stakes. You are going to lose people over it. And there's no best practices on how to arrange your student loan program. But you should at the very least be having this conversation with your benefits committee and whoever else in HR and the board, or whoever is gets to make these decisions, because this is a gigantic deal, and you will lose a lot of your millennials, maybe some of your Gen Zers, if you don't figure out a way to help them be able to pay their student loans. So thank you. TC out.